much promised management. Sanjiv Chadha, MD and CEO at Bank of Baroda, joins in on the show right now. Sanjiv, great to have you in ET now. You've said that your corporate growth is at 7 times, or rather 0.7 times of growth, and retail at 1.5 times of your overall credit growth. With loan growth now set to dip to 14% as per your guidance, will you maintain the same stance? And which segments will you be looking to grow in?
So, I think there is a broader context in which we have targeted a faster retail growth. One, of course, is the opportunity which is there, which is of course very large in retail. But from our perspective, we believe that we are overexposed to the corporate segment for historical reasons, and therefore a transformation of the balance sheet, making it a bit more balanced, is something which is conducive to risk management. So, as we go ahead, we do believe that our retail growth is going to be faster than corporate growth, although there is no gainsaying that today as we speak corporate growth has picked up as compared to 6% in the previous year. This year we grew by about 13%, and I would believe that this momentum is likely to continue as we are seeing a broadening of the interest cycle. But equally there remain large opportunities in retail for us, and therefore retail for us will form a larger part of the balance sheet as we move forward.
Guided for a 3.3% base for NIMs in FY24. Will you be able to maintain these margins because now liabilities are getting repriced higher?
So, I think it is true that in terms of liability pricing, the lag which was beneficial to the bank, that is no longer there. So, in fact, now there will be some pressure on margins from deposits being repriced at a higher rate. Having said that, I think there are some mitigating factors which are there. First, our exit net interest margin was about 3.53% now, and the overall for the year is 3.31. So, even if we factor in a bit of moderation, we believe we should be able to protect our full year margins at about 3.31%. Secondly, there is a change in the composition of book which is happening in favor of retail, where the margins are better, and within retail certain segments like personal loans which have significantly higher net interest margins, they are also growing faster. So, for retail our overall growth was about 27-28%, but the personal loan portfolio grew by 100%. Given the relatively smaller base from which we have started, I would believe that personal loans will continue to contribute to a larger proportion of retail loans as we go forward. Third, our international book, although margins have improved, but as compared to the domestic book, the margins are lower, 2% as against 3.5, 3.6%. And the kind of disproportionately large growth we saw in international for reasons that corporate credit in India, the margins were lower, that is unlikely to continue. International book is likely to grow at a pace similar to the overall loan growth. So, with international contributing a lower proportion, that also acts as support to the NIMs. So, we remain fairly confident that despite the pressure that deposit rates are likely to exert, we should be able to protect our margins to levels which are similar to what we had in the full year this year.
Right. Good morning. Mr. Chadha, talk to us about the credit cost, because that's remained at about 0.5%. Where do you see it trending, and what is the outlook in terms of your recoveries?
So, I think the benign corporate credit cycle continues, and therefore, we are likely to see credit costs which are possibly lower than trend. In our view, on a stabilized cycle basis, credit cost ought to be somewhere near about 1%. That is what we are taking as a base case. But it is possible that with the corporate credit cycle still being conducive to us, and also the composition of our balance sheet. We talked of the fact that we are slightly overexposed to corporate, but under the current circumstances, it is something which actually acts as a positive. Corporate and international together comprise about 60% of our balance sheet, and that is the one which is benefiting the most from the benign corporate credit cycle.
Right. You know, that's the other thing that I wanted to talk about. Your ROAs have touched 1% for FY23. What next could it be for you, and what is the target to reach 1.5%? Could that happen soon?
So, we had a target of ROA of 1% and a 16-17% ROE which was there for 23-24. we have hit that target 1 year early, but I think this is the year for consolidation, and we continue to keep our guidance of returns on assets and equity pretty much near our current levels.
Itina had reported that you were going for a prudent provisioning case in the case of Go First despite account being standard. I want to know how much of that has been provided, and would you be providing it further?
So I think as for normally we do not really comment on specific accounts, but in this case this is in the public domain. So we believe that we are very well collateralized as far as this account is concerned, but we continue to have a conservative stance, and therefore we have provided 500 crores as a specific provision.
All right. Thank you so much for taking time out and giving us a view on how things are shaping up at BOB. So that's the management talking about the focus on retail growth to really aid their margins, saying that pressure on margins as a liability side pressure has built a bit.